It is a great pleasure to introduce our next instructor based in Kitchener, Canada. Jeffrey Stacey is the founder of Stacey Muirhead Capital Management. Jeff has more than 30 years of investment industry experience. Prior to starting Stacey Muirhead Capital Management, Jeff was employed with a boutique Toronto investment firm where he was also a shareholder. Jeff has an honors Bachelor of Business Administration degree from Wilfrid Laurier University and is a chartered financial analyst. He is a former member of the Finance and Investment Committee and a current advisory board member of the student-managed School of Accounting and Finance Investment Fund at the University of Waterloo. He's also an advisory board member of the student-managed Ivy Value Fund at the University of Western Ontario and a member of the Board of Trustees at Parkminster United Church. Members of the MOI Global community will know and appreciate the many insights and ideas Jeff has shared with us in the past. And so it's always a pleasure to have you with us, Jeff, in this forum. And on behalf of the MOI Global membership community, I'd like to extend a very warm welcome to you. Please go ahead.
Well, thank you very much, John. I appreciate the opportunity. I'm a big fan of all the various initiatives of MOI Global and all that you do to advance the craft of investing for those of us who are lucky enough to participate through MOI Global. So it's great to be here. In terms of what I'd like to cover today, I do have an idea and I'll set it up in a minute. But just maybe to get everybody all on the same page, I'll just run through a couple of quick slides that talk very briefly to how we go about identifying investment opportunities. And there's nothing truly original here. I'm sure that many of you will share a similar approach, but we just think about answering three questions in every investment opportunity that we look at. And the first is, does it possess outstanding business economics? The second is, does it have honest and capable management? And then, like everyone, we want to purchase, if we can have a good feeling about the first two questions and we can answer the first two questions in the affirmative, can we purchase this investment that we're looking at or considering at an attractive price? And again, this isn't revolutionary, but we just like to use the phrase, great business, great people, great price. So let me break that down a little bit further before we get into the idea that I'm going to talk about today. So in terms of does it possess outstanding business economics, there's a list of many of the things that we're looking for. It's not intended to be all-inclusive, but certainly those are the highlights. Does this business have high returns on shareholder equity? Does it have a strong balance sheet and we're really looking minimal or no debt or net cash? Does the business generate attractive operating and profit margins? If it has significant brand recognition, great. Maybe it has pricing power for its products. Certainly we want to see growing revenue and earnings and cash flow over time. Doesn't have to grow every single year. But over a 5 or 10 year period, you'd want to see pretty consistent growth in revenue and earnings. And then, of course, consistent free cash flow generation. So these are not things that I'm sure many of you consider similar things in your investment strategy. In terms of honest and capable management, the biggest one far and away is we want to see the management teams that of the companies that we invest in having skin in the game. And, I always like to say, options and restricted stock units and that sort of thing can be a part of a compensation program that can work into how management gets compensated, but we really want to see them have made an investment with their own money. where there's pay for performance, we want to see measurable pay for performance and understand, you know, how that pay for performance is generated. Obviously, we want people of integrity and owner mentality, you know, and then a big one for us is just looking at the capital allocation record over time. How much money do they return to shareholders versus acquisitions, and try and make a judgment about the skill that they're bringing to that. And finally, it's just been our experience, the more time we spend in the investment business, that good businesses, great businesses really tend to have a unique corporate culture. And so we're really looking for that as well. And then on the final parameter, can it be purchased at an attractive price? We're using all the same measurements as everybody else. So this quote from Buffett speaks to me. Your goal as an investor should be simply to purchase at a rational price, a part interest in an easily understood business whose earnings are virtually certain to be materially higher 5, 10, or 20 years from now. And so, you know, we're looking at all the same measures, dividend yields, price earnings ratios, free cash flow yields, and trying to make judgments about how much those earnings or cash flow or revenues can grow over time. So that's a quick snapshot. In terms of moving on to the idea that I want to present today, my best idea for 2020, CPL Resources. Now, I'm a Canadian, so you're probably thinking CPL Resources. The Canadians will be talking about an oil and gas stock or a mining company. That's not the case. We'll get to this in a minute, but CPL is a employment services firm or a recruiting firm. Now, full disclosure, I talked about this company at the Best Ideas Conference for 2018, 2 years ago, and I'll run you through this and attempt to make the case to you. But I think in the 2 years since I presented it last, although the share price has moved up, the business has actually performed even better, and so the business is cheaper today than it was 2 years ago, and I hope I can be successful in making that case to you today. So a little bit more information. What is it? It's a leading employment services group based in Dublin, Ireland. And the services it's sort of a full service shop around all things related to the acquisition and retention of human talent. So obvious services include obviously recruitment, both temporary and permanent, workforce management, training, outsourcing, and outplacement. They have a relatively new initiative called Covalent, which is a managed services group. So for example, they might manage takeover management of a technical support or an IT support unit, and be responsible for all the hiring and management of that. And it's relatively new, but it's more of a comprehensive approach to managing the HR function. And the company's key business strategy is to avoid overdependence on any one service. So recruiting, temporary versus permanent, any one sector, so pharmaceutical versus technology, or geography, Ireland versus mainland Europe. And this is a ongoing initiative. If you looked back 10 years ago or a little over a decade ago, most of this company's revenues came from within the Republic of Ireland. And so they have this strategy to continue to seek out new services, new sectors, and new geographies. A little bit more of a corporate overview. The company was founded in 1989. It IPO'd in 1999. At last count, and I should have said earlier, this is a fiscal year ending June 30th. So unless otherwise indicated, that all the data I'm using is as of their most recent fiscal year end, which was June 30th, 2019. So at June 30th, 2019, they have 12,493 flexible talent staff headcount. So these are people that are employed by CPL but are working in their various client businesses. They also have 567 recruiters and 23 brands in 11 countries, 47 offices, and 19 specialist sectors at this point in time. So that gives you a bit of a flavor for what the company's about in terms of just some very basic market data. Current share price, €7.50. That was as of December 19th when I was putting this presentation together. It's up about 4% then, since then, closed at $7.80 today. There's 27.4 million shares outstanding. So at the €7.50 price, it's a 206 million market cap. So definitely a small cap company. So let's walk through this, and I'll try and take you through the three questions that we talked about earlier and how they apply specifically in CPL's case. So again, just quick review. Does CPL possess superior business economics? Does it have honest and capable management? And can it be purchased at an attractive price? So first up, does CPL possess superior business economics? There's the last 5-6 years. So you clearly see growing revenue and earnings, double digits most years, but some single digit earnings revenue growth across the top. In the most recent fiscal year, they grew 8% top line. In terms of net income, you can see a steadily growing number over time, and went from 10.7 million euros to 21.3 million euros in the from 2013 to 2019. Down at the bottom, I've just got earnings per share. You can see for the year ended June 30th, 2019, they had earnings per share of 77.3 cents per share, and that was up 37% year over year. The reason, and we can talk more about this later, but the 37% earnings per share growth is because they did a tender offer and repurchased about 12% of the shares outstanding. So just the difference between the top line and the bottom line growth is primarily due to the reduced share count, although they are improving margins as well. High returns on shareholder equity. You can see there, consistent high teens to 21%. That's including a pretty heavy cash balance at all points in time on their balance sheet. So if you adjust and take the cash out of the equity component and take the interest income after tax out of the earnings piece, you can see the returns on shareholder equity, or adjusted shareholder equity, if you will, go up quite dramatically and into the 20s, and in the most recent year, 34%. Just to give you a sense of the financial position, so they have 40 million euros approximately in cash at June 30th, total equity of 110 million. No non-current liabilities at all, and a healthy working capital component. Let me talk briefly to brands, because I think it's different in their industry and in the employment services business than thinking about large consumer packaged goods like Procter & Gamble or Unilever. These are all small companies, relatively speaking, but they are highly regarded in their in their niche area in which they recruit. And I'll just give you one example. You see partway down the screen, Rig Healthcare. So Rig is a specialist in locum recruiting of physicians in the UK. one of only a small handful that have been approved by the National Health Service in the UK to undertake this activity. So they're recruiting temporary doctors and technicians and nurses to fill various healthcare gaps in the UK. So even though RIG is relatively unknown to most people, in that narrow niche of the health services medical field in the UK, it would be really well known among people accessing or wanting to find employment in the UK in the temporary physician market. So different way of thinking about brands, but these are all very powerful brands in small niches. Increasing dividends per share, you can see there a pretty steady record of increasing dividends. The most recent year, they increased to 19 euro cents a share, or up 41%, following on a 17% dividend per share increase the year prior. So very healthy dividend growth here. They also have repurchased a significant amount of shares over the years. Typically, the way CPL likes to work is they do it through tender offers. And so you can see in 2011, they did a 20 million tender offer and repurchased almost 6.7 million shares at 3 euros. And in the fall of 2017, they spent 25 million euros to purchase another 3.7 million shares at 6.75 euros per share. So they've repurchased since 2011 10.3 million shares, and the company today has 27.4 million shares outstanding. So they've repurchased about 30% of the shares outstanding in the last, call it eight or a little over 8 years. And then just for perspective, over that same period of time, they spent about 22.9 million on acquisitions. So, you know, I don't think there's any magic to the 2-to-1 ratio, but they've repurchased or spent twice as much on repurchasing shares as they have on acquisitions. And then they've also increased the dividend, as I showed you earlier. So does it possess superior economics? Obviously, I'm saying yes. And if you just look at checks the box, growing revenues and earnings, checks the box on returns on shareholder equity, checks the box on solid financial position, checks the box in my view, and again, subject to an understanding that this isn't Procter & Gamble or Unilever, significant brand recognition in their narrow niches that they play, increasing dividends per share, opportunistic share repurchases. So I think the answer is yes. So let's just talk quickly about, does this business have honest and capable management? So the CEO and founder of the business is Ann Harity, and together with her husband, her spouse, Paul Carroll, they own 9.7 million shares of the 27.4 that are outstanding. So about just over 35% of the shares, total shares outstanding. So clearly they have skin in the game. It's a unique corporate culture in my judgment. They are consistently winning, you know, great places to work awards, and you can go online and look on YouTube and you'll see people talking about what a great place CPL is to work. So we think it does have a very unique corporate culture. Reasonable shareholder-oriented board. I don't have anything particularly insightful to add. They've had some longtime board members, but they keep also bringing in new board members. So I think that's a good balance, you know, and they certainly compensation that both the board and senior management are getting seems quite reasonable to me. You have consistent return of capital to shareholders through share repurchases and dividends. And, you know, that's where a board can certainly be a driver of value by holding management to account to look to returning capital to shareholders. And, you know, just a couple comments on Ann Harity. She's won many, many awards over the years. Just highlight two for you there. And is an extremely accomplished executive. So in my opinion, very quickly, does CPL have honest and capable management? Obviously, my answer is yes. Skin in the game. They own 35% of the shares outstanding. Reasonable compensation practices. Capital allocation records. So again, I'm you know, acquisitions versus share repurchases versus dividends. I think they're striking a very good balance in that regard. Unique corporate culture, yes. So I feel it does have honest and capable management. So just moving on then very quickly to the price or valuation component. Can it be purchased at an attractive price? So I just wanted to go back and compare from the best ideas when I presented this at this time 2 years ago. So the share price was 6.22 euros, and yes, today it's 7.50, 7.80 actually today. I was pricing this as of December 9th. And then if you look at the cash per share, so in 2018, coming off the tender offer in the fall of 2017, they were down to 30 euro cents. So 6.22 less 30, 5.92. Well, today that cash per share is right back up to almost €1.50 per share. Even though they're raising the dividend consistently, they haven't done a tender offer. I think that's certainly likely again sometime soon, but we'll see. But again, so you know, the share price net of cash had moved very marginally from 5.92 to 6.04. At the same time, dividends and earnings and cash flow are going up. So you can see back in 2018, the trailing PE excluding cash was 13.5 times. Today at 7.50 share price, it's 7.8 times. I just threw in the trailing dividend yield for you. So, you know, the price has moved up certainly, but the dividend yield's actually higher today because of the increased dividends per share. And then I just referenced an earlier slide for you there. Return on shareholder equity excluding cash was 25% when I presented it 2 years ago. It's now up to 34% today. So I obviously think the share price is pretty attractive. In terms of outlook for the future, I would just make the comment, you know, since they went public 19 years ago, it was a very small company when they went public. They've basically compounded top and bottom line, just about any of the metrics you would want to consider at least a double-digit rate over time. Compounded annual growth rate. I'm not saying they've done that every year, and certainly you saw earlier in revenues, they've had some single-digit revenue years, including last year, revenues only up 8%, but over time, 10%. So I can't point to anything obvious that would lead me to the conclusion that they can't continue to grow more or less at these kind of rates into the future. So I just am playing around with some numbers here. This is certainly not a forecast, and you'll notice I said what price could CPL trade at, not what price will CPL trade at, or what price do I guarantee CPL will trade at, but I just tried to extrapolate some numbers going forward. So just very simply, taking the share price from December 19th and the trailing 12-month earnings of 77 euro cents, And if we compound that at 10%, 5 years out, earnings will be 124 a share. We put a 15 times multiple on that, and I understand many people might say that's too high, but that's below a market multiple. That would make the market price 18 euros or almost 19 euros 5 years out, and that'd be a 19.9% compound, excluding dividends. And, if you generated cash and retired shares at a quicker rate, you might get some pickup there as well. But in my judgment, this is setting up an attractive rate of return, and just using the current yield of 2.5%. Now we're talking, north of 20% compounded rate of return. If they can keep growing at 10% plus, and the market maybe gives you a little bit of a multiple pickup from where it was 2 years ago when I presented, and certainly it would be a multiple enhancement from where it is today. So in my judgment, very simply to summarize this, I think CPL is a great business run by great people that's trading at a very attractive or great price. So John, that's a quick romp through CPL Resources, and would be happy to take any questions.
Well, Jeff, thank you so much for the presentation and for revisiting this idea. And what I found interesting was, even though the price has gone up a bit, those valuation metrics actually look better than they did when you presented it the first time. Perhaps I'm curious, in terms of this growth rate of just about 10%, it sounds like that's been organic growth of the company over the long term. Is that right?
Yes, they do. Their approach to acquisitions is they have never done anything big. Where they do an acquisition, it's usually small and a tuck-in acquisition. So there is some modest acquisition numbers reflected in that 10% growth rate. But I also would say I think it's fair to call it mostly organic.
Understood. And in terms of the growth going forward, do we have a sense for where that will come from? Is that simply by virtue of the markets that they're in growing at about that rate, and maybe CPL getting small share gains here and there? Or are there adjacent markets that might be of interest? How does that growth going forward look like, and what does it consist of in your mind?
I guess I would say all of the above. Clearly they would like to get share. Clearly there's organic growth in the base business. They will likely grow geographically by setting up new offices in new geographies. And they will also push out into new but related services. And I briefly mentioned Covalent at the start of my presentation. So Covalent is a new initiative bringing together some parts that they already had within the company, and it's a managed services business. So they go out and, if you go on their website, they have a couple of case studies, but the one I liked was they took over, the IT support center for a technology company, where they're responsible for staffing it and managing it. And, the company in question just turned that role over to CPL. So I think you might see some broader gains in business away from the traditional recruitment, whether that's executive recruiting or permanent recruiting or temporary recruiting. The other trend that's going on, which is also why I really like CPL, is the growth has been coming, although they've been getting growth in both permanent recruitment and temporary recruitment, the real growth is in temporary. And even though that historically has had lower margins than permanent recruitment, they've been able to improve their margins over the last several years. And so, again, I just think you look at this whole mix. Yes, they want to grow the base business. Yes, they'll expand geographically. Yes, they might push into some adjacent sectors. So it's really going to come from all of the above.
And Jeff, in terms of risks to the thesis here, is there anything that is top of mind for you that could upset the apple cart, as it were, particularly over, let's say, a 5+ year time horizon?
Well, certainly the big one is just, recession or poor business conditions. I'm not going to come in front of you and say that, if business conditions were lousy, that they could continue to grow at above average rates. But with that said, I must also tell you, this has been a very resilient business. If you go back to the depths of the financial crisis, when at that time CPL was, call it 90% an Irish-based business, and you had 28% unemployment in Ireland, this company still made money. Now, admittedly, break even might be a better way to describe it, but that's pretty powerful. So they've been able to also manage their cost structure. So, if you got into poor business conditions, which in turn impacted hiring, I think they've had a good track record at adjusting their cost structure as well. So, I guess I don't want to overplay the recessionary comment or underplay it. They've had a good history at just adapting and moving forward regardless of business conditions. Of course, you could argue that if we got a business pickup, I just think that would be helpful to CPL on a number of scores. Not only would there be more hiring going on, but you haven't had a lot of price inflation in salaries and wages and that sort of thing over the last decade. So, they're not getting a lot of their revenue improvement isn't coming from the flow through from that. So, that would be the offset on the other side that you haven't really seen. They've been generating these results without sort of inflationary benefit or salary escalation benefits that would flow through to them. So, as I say, I'm not going to, it would be cyclical if you got into a severe business downturn, but they've also shown their ability to manage their way through that.
And perhaps lastly from me, on the capital allocation side, is there anything you'd like to see prioritized differently than the management has been doing?
Not really. The cash has built back up to a record level. So, I think there's a possibility that you might see share repurchases again in some form. I also don't, although their history has been to grow organically, if the right opportunity came along for them to acquire something, I'm not adverse to them doing that. when they do acquire things, as I mentioned earlier, it tends to be smaller bolt-on where maybe they like the people and or it's a close adjacency in terms of a sector or a service. So I'm reasonably satisfied with how they go about it. I'm not saying that the cadence might not change, in one area or another over time based on the opportunities they find. But I have no quibble with their overall capital allocation record. And so I'm not concerned about that.
Wonderful. Well, Jeff, I will leave it here. I would just encourage our members to feel free to follow up with you with their own thoughts or questions, either directly or to contact us, and we will be happy to facilitate an
And happy to
introduction.
hear from anyone, John. I'll do my best to respond in a timely fashion to any inquiries that come to me. And I just thank you for the opportunity to speak with the MOI Global community, and I'm happy to help in any way I can.
Terrific. Well, that's very much appreciated. And Jeff, it's always a pleasure to have you here and benefit from your wisdom and ideas. We truly appreciate you taking the time to share with us again today.
Great. Thank you so much, John.
Thank you and goodbye for now.